Let's talk money.
Hello and welcome to a brand new edition of Let's Talk Money with me, Surabhi Upadhyay. Now, a lot of you would have been watching the market headlines glued to your screens, looking at the tremendous volatility that has hit markets around the world, not just in India. And you could be talking equity, you could be talking fixed income, and even currencies. It's all going topsy-turvy thanks to Trump's tariff plan. The question that a lot of people are asking is what should they be doing when it comes to their investments, our mutual fund holdings? Is this a great time, a great dip to deploy more money? Should you wait? And if you want to add more money, then what kind of funds are perhaps best suited for the new normal, this new environment that we are in? Well, to help us, understand some of these issues and navigate them, we have with us Harish Krishnan, Co-CIO and Head of Equity at Aditya Birla Sun Life AMC. Harish, thank you so much. I know it's extremely busy. You folks in the office must have had lots of, turbulent mornings and evenings. So really appreciate you taking out the time to join us here today.
Thank you. Delighted to be on your show, sir.
Well, the reason we wanted to do this and do this now, Harish, is, as I said, we've got a lot of viewer queries, and I'll get to them in just a bit. People have learned after COVID that dips are usually the best time to buy, but it's still confusing.
Sure.
And it's still a little scary. So your opening thoughts?
No, so, contrarian thinking doesn't come naturally to human beings. When things are going well, good news gets amplified, and we start to look at echo chambers which amplify that news. And similarly, when bad news comes through, the same reverse process happens. Good prices and certainty don't come together, okay? And therefore, it is important to cultivate a habit of being contrarian. Now, being contrarian for the sake of contrarianness never really works, right? Just because everybody else is doing something, you're doing something else.
Different.
I don't think we want to be that. But we need to have a framework of asset allocation, okay, which helps us navigate these kind of uncertainties. Because in markets, uncertainties are a feature, not a bug. It's not an aberration that you have all of these things coming through, right? Yeah. Every now and then you will have new events, some business cycles going bad, etc. It's all part of the overall game. Now it is up to us how we react to these developments rather than just going by what, say, the newspaper headlines tell us.
Yeah.
To kind of second guess and to think maybe half a step ahead of what the newspaper headlines are today talking about, rather to think about what the newspaper headlines can be talking about 6 months down the line. I think if we are able to cultivate that, we get into a much better mind space wherein we can take far more intelligent decisions about how we manage our own wealth.
So I take your point, and I'm not going to argue against that at all. I think, and history has taught us, n number of times, that when the market is really capitulating, if you're able to deploy some money, invest at that time, that is when you make outsized returns over longer periods of time. So no arguing that. But my question here is that COVID was relatively easy from a market standpoint. It was a nice V-shaped recovery. The market didn't look back. It just kept, tearing higher and higher, at least for the next 1-2 years, right? Now, given this new situation of tariffs, would it be a little silly to expect that kind of a quick recovery for people who are willing to punch in the buy orders now?
So let us examine the market correction, because it's been in a corrective phase for now about 6 months or so. From September of last year is when it started correcting, right? So we were going through a phase of valuation-driven excesses getting corrected out over those 6 months, and there are multiple reasons. Earnings kind of slowed down. There has been some kind of global turmoil, etc., right? So what became a garden variety kind of a correction, which is more driven by business cycle and, say, earnings slowing down.
A garden correction, garden variety correction.
Garden variety, because it is but obvious that you see a 10-15% drawdown once a year. It is nothing unusual. Of course, post-COVID, maybe those occurrences have been so far and few that people's memories have kind of got wiped out from that. But this is pretty much normal, right? So from a very natural garden variety kind of correction, we have actually now gone into a man-made reset, which is what Mr. Trump with his tariffs have done.
Sure.
Now, has there been such man-made reset buttons in the past? Absolutely. In fact, in our own country, I mean, if you look at, say, November of 2016, wherein we had demonetization, we had a reset button being pressed, right? And we know how that kind of eventually turned out, okay? Yes, during that phase of reset, yes, is there absolute certainty? Absolutely not. But what we've seen time and time again is that while these events may be new, it could be a liberation day, it could be tariffs, it could be wars, it could be geopolitical, a number of reasons that can cause it. The response of the market participation or of the market participants has always been consistent over the last 500 years, which is the behavior of market participants oscillates between greed and fear, right? Now, if you are able to harness signals which kind of say, are we getting more greedy as a segment or are we getting more fearful as a segment, then we have a way of second guessing the market and trying to see that can we be half a step ahead. And at this point of time, it does appear that, you know, we are a bit too much fearful about markets. There are multiple indicators and we can speak about what are the different kind of indicators that we look at that gives us that kind of a sense.
So that, you know, in a sense is the crux of the conversation that we're going to have over the next, 15-20 minutes. That how do you overcome emotional biases, extreme fear, extreme greed? Right now we're dealing with extreme fear. How do you overcome that to ensure that you're investing right for the future? Are there some products in the mutual fund industry that help us do that? If I might be too fearful, but if I'm disciplined in that product, in that particular fund, then can the fund do it for me? We'll get to that in just a bit, but I also want to take some viewer questions, which we are getting along the way to kind of answer them. We'll start off with this one. This is a query from Harsha Subramaniam. He's asking whether it's a good time for fresh deployment into mutual funds, given the sharp correction in the market and in fund NAVs. And he's saying, would a multi-asset fund be a better approach for a fresh lump sum investment right now than a large cap fund? Harish?
So yes, I do think that, compared to what it was 6 months ago, where there was a lot of overvaluation, things have kind of settled down quite well. Our macro fundamentals are extremely strong. I'm saying India as a country as a whole. And companies are in very good shape. The balance sheets are in very good shape. So it is just that the investor expectations and exuberance had kind of gone a bit too much, which has kind of corrected itself. So typically we've seen, say, a median stock correcting by about 35% in the last 6 months, which is generally the threshold of all previous corrections, unless there has been, say, a global financial crisis or a COVID, where the drops have been slightly more. So you're getting into a reasonable zone where there is some amount of margin of safety, unlike what it was. Right? Now, coming to where do we deploy it?
Exactly.
Okay, do we get into a traditional diversified fund, or do we get into an asset allocation? Large
cap, flexi cap, asset allocation. I think this is a very common question that a lot of people have at this point.
So let me start out with saying that, asset allocation solutions provide investors to give a larger sum of their monies in a more tax efficient manner by investing across asset classes, right? And this is borne by data, right? So if you look at an average folio value of any other category of mutual funds, including large cap, tax saver, mid cap, small cap, etc., the average folio value is roughly about 1.5 to 1.6 lakh rupees. But if you come to an asset allocation product, be it that of, say, a balanced advantage fund, which has got a slightly longer vintage, or say a balanced fund, that number comes to close to about 5 lakh rupees. So we already are seeing an average Indian investor deciding to put big amounts of money in these categories.
In the asset allocation
products. Now, why is it that they do it? Asset allocation, firstly, it invests across multiple asset classes, right? Which makes it much more tax efficient than you personally investing. That is one. Secondly, the weightages given to various asset classes are also determined by the fund manager, typically in conjunction with a model, which tries to reduce some of these emotional biases that otherwise plague individual investment, right? So that's the second thing. And thirdly, the benefit of allocating across asset classes is that it's the same nursery, kindergarten kind of a thing. Don't put all your eggs in one basket.
Absolutely.
Primarily because that each asset class responds differently to uncertainties in different points of time, right? And therefore, by putting it together, your overall volatility, or let's say the BP of investment, that reduces quite dramatically compared to putting in a pure equity fund.
So, coming back specifically to Harsha's query, and the multi-asset category is being pushed very much by the mutual fund industry as well as a good tool to diversify across asset classes. In terms of return expectations, since he's asking specifically about large cap funds versus asset allocation, multi-asset funds, over let's say a 3 to 5 year period, what should my return expectation be from a MAF, the multi-asset fund, versus a traditional large cap?
Sure. See, any asset allocation product has a trade-off. There is no free lunch, as they say, right? Okay. Now, a pure 100% equity, be it in large cap, mid cap, or small cap, over a 5-year, 7-year, 10-year period will always give higher returns than, say, an asset allocation product. But the idea of an asset allocation product is to get you better sleep, lower BP, lower volatility, right? Yeah. So, over the next 3-5 years, I would think that the returns are broadly similar. So, for example, let's look at the past track record. Yeah. Okay. So, if you look at, say, some of our balanced funds or, say, the balanced advantage fund, because they have slightly more vintage. Yeah. MAF as a category is new, so I'm using some other parallels, right? If you look at, say, our own balanced advantage fund, we've captured about 85% of the market return, okay, with the volatility of 66% of that. Right? Okay. So if equity markets give, say, X amount of volatility, a product like BAF gives you 0.66 of 0.66 amount of that volatility, right? Yeah. But obviously returns over here are, say, Y. Here the returns are 0.8 or 0.85 times Y. Okay. So that is the trade-off that one is talking about. Now, the greater peace of mind that it provides you helps you allocate more amount of money. Sure. So if you're a first-time investor and you're confused and you're thinking that, you know, so much jargons are being spoken about, this becomes a very simple product or a destination wherein an investor can put in a larger sum of money where the allocation happens automatically in a very tax-efficient manner. Right. Okay. There is a significant tax incidence when you do it yourself. In a fund product, that tax incidence comes down meaningfully. Absolutely, because the fund is doing the churn. You're not doing it yourself. So, you know, that's on MAFs and BAFs. I just want to make a distinction over here. We spoke about multi-asset funds because that was one of the questions that we got. But otherwise, going back to the concept of rules-based investing, there are two categories that stand out here. When the fund itself, the product itself, is going to do that rebalancing for you, basically the shift between, let's say, equity to fixed income or fixed income to equities, or maybe even some other asset classes. Now, here we are talking about the quant category, quant funds which do this, and the balanced advantage or the dynamic asset allocation category that, you know, Harish, you spoke of. Now, help us understand between these two, and quant is also a very, very new category. If we talk about balanced advantage, which is older, how do balanced advantage funds typically work in a market like this? How do they decide that now it's time to load up on equities? And how do I know? And is it the same formula, the same pattern that all BAFs follow? As an investor, I mean, those are the details that I'd want to have. Sure. So, see, fundamentally, be it fundamental analysis, technical analysis, quantitative analysis, behavioral analysis, there are many ways to invest money, right? There are only two signals that one is looking at, okay, to keep things simple. First is trend following or momentum. Even in fundamental, when we are looking at an annual report, all we are saying is, okay, this has been the pattern of, say, sales growth. Is it likely to continue basis certain expectations, right? So that is trend following, okay? The second signal that we talk about is reversion, which is that has it gone too much, too far, that it tends to reverse. Now, what we've kind of discovered over our journeys of investing is that trend following is very good when we go down the curve, which is while we are looking at stocks to identify, okay? Whereas reversion to mean, okay, works very well when we are talking about, say, asset classes, market caps, etc., which are higher up the plane, right? So when it comes to asset allocation products, we typically use mean reverting kind of variables to focus as to when do we go contrarian, right? But when it comes to, say, quant funds, where the mandate is, of course, our mandate is to be fully invested at all points of time. So we're not taking a cash call. And over there, we are primarily looking at some variation of trend following to get the maximum bang for the buck over there. So this is a very aggressive product, okay? But both of them work with a similar premise that there are emotions in both ends, be it in trend following or be it in reversion to the mean, right? The idea of rule-based investing in both these categories wants to eliminate that element of behavioral bias by making it into a programmatically algo-driven or flowchart-driven, etc., which helps people or the fund manager decide what is the right way. Because uncertainty impacts everyone, be it an amateur investor or a professional investor. And these rules, therefore, help us doing. Now, coming to balanced advantage fund or those kind of categories which look at reversion to mean. Now, like I said, the behavior of people are always mean reverting between greed and fear,
Sure,
right?
sure.
Now, there are multiple ways in which this greed and fear signal can be manifested and harvested, okay? One simple way is the valuation, be it, price to earning, price to book. You generally see, for example, in India, when price to book crosses 4 times, it's generally seen as an overheated, exuberant market, and when it comes below, say, 2 times, generally seen as a market in it. So that's a very simple valuation-driven thing. You also have, say, Cape Shiller, etc., more complicated formulas as far as valuation is concerned. But we also know that just relying on valuation is not going to do the trick, because markets can remain irrational for much longer.
Absolutely.
Right?
Yeah.
So therefore, we use other indicators also. So what are the other indicators? Some of the indicators can be, extent of valuation mainstreaming. So let's say if there are, say, 500 companies or 100 companies in your universe, what percentage of companies are beyond...
How many are overvalued?
Overvalued.
So it gives you a sense the markets may be in an exuberant zone.
So that could be one.
Yeah.
The second way or another way in which we can look at is the number of multi-baggers that have happened in a short span of time. So the number of 10 baggers in, say, 3 years or 5 years, that also follows generally a mean reverting kind of thing. Similarly, if you look at, say, the number of stocks which are making all-time high, that also follows a very mean reverting kind of a thing, right? Similarly, if you look at, say, the number of stocks in portfolios of various fund managers, you generally see that in a bull market, you will generally see many names getting added.
Right.
Okay, more news stories, more IPOs, all of that keep getting added. And in a bear market, you will see the complete reverse. So when you see these points of inflection, that is when you start going the reverse direction and saying that, okay, now maybe we are getting a temperature check from the market that there is too much of fear. And therefore, it makes sense for us to go contrarian. So the idea of these products is not to time the markets. We are just trying to gauge the temperature of the markets and trying to be contrarian to that temperature.
Okay, all right, got it. So these are some of the indicators or some of the the rules that funds follow. I'm talking about the balanced advantage category or the dynamic asset allocation category, even quant funds. These would be some of the parameters that they follow to decide whether it's time to have more equity or more fixed income or vice versa. Just want to take a break by talking about the returns. Maybe we can pull this up on the screen as well. So a balanced advantage fund, what kind of return can it give you over longer periods of time? We've taken the Aditya Birla Sun Life Balanced Advantage Fund for an example, I mean, in the sense of an example. So the 3-year return, and these are rolling returns, the 3-year return is about 11.3%, which is actually better than the category average. The 5-year return is about 10.7%. So this is typically, what these funds are doing, which are not bad returns. I mean, 10 to 12% returns over long periods of time, perhaps very reasonable returns to have. Quick break. On the other side, more of your queries answered. Just a moment and we'll be back.
Let's talk money